Imagine an investment that never loses. Year after year, through every market crash and economic dip, your portfolio yields a steady 10 to 12%. This wasn't the pitch of a fringe scammer. It came from a man at the absolute center of the financial establishment. Bernie Madoff founded one of America's largest market-making firms and served as the chairman of NASDAQ. To the world's wealthiest investors, he was untouchable. Then came a single morning in 2008. The profits vanished. The investments were revealed as fiction. $65 billion in reported wealth was gone. Madoff successfully bypassed the world's smartest institutions by prioritizing human psychology over financial math. To understand the scam, we have to look inside the machine. Imagine 10 friends give you $10,000 each to invest. Instead of buying stocks, you place that money in a central box and simply leave it there. When one friend wants to withdraw their profit, you pay them using the cash deposited by a brand new investor. They believe they've made a gain, they tell their friends, and the cycle accelerates. This is a Ponzi scheme. It is a mathematically doomed engine that requires a perpetual, expanding pipeline of new money to prevent total collapse. Madoff kept that pipeline full using 3 specific strategies. First, he was modest. By promising a reliable 12% rather than a suspicious 100%, he disarmed the skepticism of even the most seasoned professionals. Second, he used exclusivity. You couldn't just buy into his fund, you had to be invited. This created an atmosphere of a private club, making the ultra-wealthy compete for the chance to give him their money. Finally, he relied on social proof. Because banks, charities, and celebrities were already in, everyone else assumed the necessary background checks had already been done. These 3 factors created a collective blind spot. Investors stopped looking at the balance sheets because they trusted the reputation of the man and the crowd following him, but the math didn't add up. Financial analyst Harry Markopolos realized those consistent, smooth returns were a physical impossibility for the strategy Madoff claimed to use. Markopolos sent detailed reports to the SEC for years, but Madoff's stature was so great that regulators repeatedly failed to investigate the evidence. Then the 2008 financial crisis arrived. Panic swept through every corner of the global economy. Terrified investors suddenly demanded billions of dollars back at the exact moment the flow of new money stopped. The math finally hit a wall. The global market crash acted as a final stress test, stripping away the deception and revealing the empty accounts beneath. In December 2008, Madoff confessed to his sons that his business was one big lie. The FBI arrested him the next morning, sending shockwaves through the world's financial capitals. The damage was immense. Thousands lost their retirement savings, their homes, and their charities. For many, it wasn't just a loss of money, but a total destruction of their future. Madoff pleaded guilty to multiple counts of fraud and money laundering. He received a 150-year prison sentence and died in custody in 2021. The scandal forced a transformation in the financial world, leading to stricter auditing and far more aggressive oversight by regulators. But the most important lesson isn't about regulations. It's about how easily we trust a believable promise when it's delivered by a trusted face. In any investment, if you cannot understand how the money is being made, you are likely the product.